So more numbers equal more opportunities. When I wrote my book, I was only working with Fibonacci and Lucas numbers, but when we combine the ratio work, we're opening up to greater possibilities, profiting opportunities, and you can use almost any set of numbers. All you need is a really good ratio between price and time to get a better, more opportunities. Because let's face facts. And as you've seen on just a few charts that I've shown you, is that not every symmetry is going to turn on a Fibonacci number. Not every time cycle is going to end on 55 bars or 89 bars or 161 bars. What's vitally important for you to understand is not only do we need to have the right number of bars, but we also need to have the right number of points lining up with that, or else the move isn't going to work as well. And I guess the last thing that I want to say about this is that when I wrote my book, the purpose of the book was basically to make people aware of time symmetries, because most of the people who wrote the book, who read the book, weren't even aware of that at that point. I mean, here we are, we're battling Malkiel on Wall Street, and they're telling you that you can't even time markets. And in my work, I came to realize that as a leading indicator, a time window, the market may or may not turn at that window. And I said, well, how do we know, and how could we increase the percentage of time that it's actually going to do what we think it could do? Well, that's when I started doing the ratio work a couple, 3 years back. So you ask yourself, how do you trust a retracement? Well, give it a great square reading. Here you have a standard move up from here to here, right? Now we put 38% retracement on there. How do we know that that 38% retracement is going to hold? How can we have the conviction? Well, we had an 8.4 point move in 18.5 bars. We do the math and find out that we averaged for this particular pullback 0.45 points per bar. And if you're into Gann, you know that numbers like 45s and 90s and 180s and 360s are very important. If that number, when you punch the calculator, if that number means nothing to you, probably isn't going to be a good bottom. But if it does mean something, well, then you've got something significant. But still, I'm a pragmatic, practical kind of guy. You still don't take the trade. You've got to get a good reversal. And so what I do is I take a look at the last bar down, and I'm going to wait to see that we actually have a candlestick reversal. And you can see once we get the good reading, we've got the good retracement, we get the reversal, and once we actually get the confirmation of the candle reversal pattern, then you go long. So if you do all of these things, if you take this checklist, take it really seriously and dig one level deeper, what you are going to find is that you probably will end up taking less trades, but what you'll end up doing is taking more high-quality trades. And this is a close-up of the same bar. We've got that 0.45 reading down here. It takes off, and then what ends up happening is that we're still retesting polarity over here. And as it turns out, this reading over here ends up being a 0.6260 reading, which that's another good situation. And you see, last bearish bar over here, it congested a bit, and then it gapped up, and that's your buy point. You've got everything lining up here. So you actually have two different opportunities in that sequence. Now, on this sequence, a little bit different, it's one of these intraday sequences where the extensions did work. So from this last leg down up to here, you got a 2.618 extension, but how do we know to take that extension? Because, well, we don't know that this is really going to be any good. Now, certainly, I didn't know that this is going to be as whipsaw or as volatile as it was, but that's not the point. The point being is that this particular leg, when I do the math and come up with my ratio, we come up with a 0.359 reading, which is just a hair off of 360. So once again, we know that the trend has changed, not only because of a good extension, but because of the good under the curb, under the radar, under the hood reading right there. Now, if you're trading on things like the Russell, you should pay close attention to certain magnet points on charts. For instance, the Russell 610, 618. You'll find that these different Fibonacci numbers, these different geometric numbers are going to end up being natural support and resistance points. And what ended up happening here is that not only do you have the 617, which is a natural resistance point, we have a 108 square, and even the 1.26% percentage change here. So everything was lining up here. And what you should also come to understand is that the more factors that are lining up at the pivot, the more explosive the move can be. And look at this, straight down. So if you're really looking for explosive moves, this is the reason why they materialize this way. Hang on. Get the cursor going there. Okay. Now, this is a chart of the dollar from a year ago. It's not this year's sequence. This is the 2009 sequence. This led into this is last summer. This is basically June 2009. To give you an idea of developing conviction, at the beginning of June, we had a turn, and we ended up having this very congested pattern, probably a triangle. But at some point in time, what ended up happening is that we were 360 bars off the low, and when I measured the price from here to the price from here, all of this action came out to 0.0061 points per hour for the entire 360 hours. Why was this important? Because this particular high was challenged on several occasions, but it was never taken out until November. And if you're looking for reasons to have convictions about moves, I know I sound like a broken record. You're not going to get a better way to have conviction unless you truly, really come to understand patterns. And basically what we're doing here is this is not a Fibonacci webinar or methodology or everything that I'm going to show you. These are just different tools to understand and recognize patterns, because quite frankly, my definition of recognizing a pattern is different than a lot of people. And so this is obviously not the current chart of the dollar, but this was a view of the dollar that was taken after the November bottom. I'll show you the current dollar chart later on. But what ended up happening for this entire bear market on the dollar is that it did average 0.144 points on a weekly chart, and the last leg down on a percentage change basis from here to here was 23.4%, and when we manipulate the decimal point, we know that that's very close to 233. This is right on 144, and this is basically what turned the dollar back up at that point in time. So the key points to remember here in summary is that what I've shown you up to this point are the underlying structure of all markets. They're leading indicators. We no longer need RSI, stochastic, MACD. You can use them if you like, but in my estimation, they're lagging indicators. We're always waiting for the change of direction. As I told you before, we don't front run the bars. We want to get at least 2 signals before trading and wait for a confirming bar, which is a candlestick reversal pattern. Now, in the next phase, I'm just going to show you some interesting other out-of-the-box pattern recognition schemes that you could be aware of. This actually was the nat gas chart, not this September, but last September. And now that you guys understand what a square is, it actually averaged 0.429 points a day in 429 calendar days, which that was the low for last September. At that point, we had a high on the continuation chart at 15.517, and if I'm not mistaken, that's probably a secondary long-term high. There was 305 trading days, 429 calendar days. So what we end up doing is taking a range of 13.108 divided by 305 trading days. It gave you a reading of 0.0429 on the 429th calendar day. So let's just understand something. This is way below the surface. It's not easy to come up with, but in essence, what we had was a calculation based on 305 trading days over 429 calendar days that lined up with the ratio and the calendar day to give us the reversal. I know that's a mouthful, but that's exactly what turned that market. And you guys will remember last year we had a very significant turn in the sugar chart. And what ended up happening there was this particular bull market was up 318 days, nothing rare about that, unless in the longer term it was also up 317 weeks. So what we ended up having at the turn in sugar, I guess that's what, back in February, is that the smaller intermediate trend was 318 days, the larger degree trend was 317 weeks, and when those two clustered, you got this massive explosion reversal, and you can almost, I guess you could say that the sugar market crashed. I mean, it's just a words at this point, but that was, if you don't want to call it a crash, a major sell-off, whatever the case may be, that kind of conviction is if you're sitting there at a top and you're analyzing these charts and you come up with a symmetry like that, some bell should go off in your head and go, hey, this is probably significant. If I'm long, I should probably get real defensive, and if it follows through with the candlestick, I might be one of the first guys on the block to go short. And the whole idea of trading is to have an edge over your fellow traders and recognize the pattern before they do.